So, good morning, everyone. Welcome to Farmers Keepers Q1 webinar about how to use grain pricing tools at your local elevator and also through us. I know everybody's busy here. We're coming to you live from our office. You can see Jack and Jeremy are on camera, but everybody else is listening in. And we want to make this a concise webinar that we're also recording that's going to go out there to YouTube and all the different social medias, because we don't think there's enough information out there for farmers about how and when to use different grain pricing tools that are available. So what we're going to talk about and show you today, just keep in mind, this is not necessarily particular to selling grain through Farmers Keeper, where of course you don't have to worry about where you're going to deliver it yet, because you can deliver your bushels anywhere. But when we're talking about an HTA or min-maxes or accumulators or anything like that, with some small variations, this is pretty much universal at any elevator that you're going to deliver to. So we want to put that information in your hands so that you understand it, because not everybody in here gets the attention that they might want from their local merchandiser, or they might not know what questions to ask about things. So we want to clear the air with all that. Everybody that keeps joining here, welcome in. So we're going to go over, in general, what are the pricing tools. But first, I'm going to give you a couple minutes on updates about Farmers Keeper, and we'll go into how they work and when they're typically used for an HTA, Hedge To Arrive, average price contracts, floors, min-maxes, also known as collars, and then another one we've all heard of that not many of us understand, which are accumulators. We'll also build out time for any of your questions. But if you have questions while we're going over anything, please put them in the chat below, or unmute yourself and just yell at me and say something. Those of you guys who are our customers, you know how to yell at me. All right, let's get that done. Couple people are coming in. Let's move on. So really quick about Farmers Keeper. We've been growing a lot. 2023, we already know, is going to be our biggest year ever. In terms of bushel quantities, we're already under management between pricing tools and our managed pricing programs. We have more bushels for the 2023 crop than we did for all of 2022. So that's a big accomplishment. It's a testament to more farmers turning on and wanting to do pricing tools through us to avoid margin calls and get their hedge cleared with the same clearing firms the elevators use, and still be able to deliver their bushels wherever they want so they can get the best basis available. We've also been picking up new farmer customers at a much faster pace as we continue to be better known out there. And that's also a testament to many of you that I can see on the call today that help us with referrals or anything and say to other farmers, yeah, this is legit. This is a good way to sell your grain. Go execute your marketing plan this way. Some of the things we're working on for 2023 is we're working on scraping technology for settlement sheets and scale tickets so that we can increase the speed of you getting paid once you deliver your grain. We want to get that to at most 2 or 3 days in pretty much most scenarios. We're also, because we've grown our relationships with so many of you, especially those of you that are larger producers, we've been working on this year credit increases with you to make sure that you've got the grain that you're trying to commit so that we can expand those relationships with you. And in those cases where you're selling more than $1 million worth of grain through us and our clearing firm partners, that's, some of you have already gone through this. Some of you we're starting these conversations with that are at those levels, which $1 million of grain is not a lot these days, as we all know, especially with these prices. But that's where we're asking you for a schedule of crop insurance and a most recent balance sheet or a 1065, so that the clearing firms can validate all that stuff, do their thing, and we can get you going and selling more grain that way. And then also, our business has transitioned over the past year or so from where we mostly started, which is a growing segment of our business of managed pricing programs, which those of you that are our customers on this call now or that are going to be listening later on, many of you, most of you are in those managed pricing programs, but we've also transitioned to most of our volume now is actually through these individual pricing tools we'll talk about. But as far as the managed pricing programs go, we launched our biggest pool again ever this year. It's tens of millions of bushels of corn and soybeans. Farmers from 24 different states, from North Dakota down to Mississippi. Love you guys out there in both states, all across the I-states, out to the East Coast even. And in our previous webinar, we talked about with Ryan Darnell, who's out of the pricing desk at StoneX, we talked about the blended portfolio strategy of pricing and managed pricing programs and what goes into that. So a lot of exciting stuff going on here for you to make the product better that we're giving you. So here's the basic pricing tools we're going to talk about today. And I just want everybody to keep in mind with all of these, again, these are what the principles we're going to talk about when and how to use these are pretty much universal at your local elevator too. So this actually has nothing to do with you even selling any of your grain through Farmers Keeper and our clearing firm partners, because anything what we're looking at here is, especially through us, fully customizable by the futures month contract that you want to put, the expiration on anything that involves premium, all the different strike levels, of course, that are possible with where the market is. And keep in mind, you can always place offers on your grain so that if you're sleeping or planting or down in Florida, and the market hits a certain level, you can capture that level within your grain marketing plan. And another little tip I want to add there, I don't think we see enough of farmers, especially in high markets right now, placing offers as stop losses below where the market is today. You know, you may be waiting for a price level to hit, but it's not guaranteed that if you just wait that a certain price level is going to hit. Sometimes it's good to take your losses too if you're waiting out on something. And then I just want to highlight for everybody through Farmers Keeper or doing it directly through your elevator, which also makes sense. And we direct many of our customers to do that in certain cases. Physical delivery obviously is going to be required for any structure that you execute. So why do farmers use grain pricing tools? If we think about your dad or some of our grandfathers or great-grandfathers, when farms were a lot more diversified between livestock and growing oats and wheat and all this stuff, there was more of a tendency to just sell a lot more grain when you needed money or at harvest. And now in the past 20 or 30 years, grain pricing tools have become a lot more prominent. So why do farmers use grain pricing tools through Farmers Keeper? Number one, to avoid margin calls. Right now, inflation is at 7.5% for most farms, maybe a little higher depending on your particular situation. That's really expensive to margin $1 million or $2 million or more worth of grain contracts. So we're using the same clearing firm partners that the elevators are when you execute any type of pricing tool there. We're just leaving your delivery open so that we can swap it in wherever you want to set your basis. Big key there to take off some pressure from your books. Second, it's the flexibility, like we're saying, to play the basis, which to us means locking in your futures price ahead of time, no matter which pricing tool you're using, and then being able to allocate those bushels to wherever the best basis is available. So if you're a producer that delivers to more than one grain elevator and you're worried about margin calls, it's probably a really good fit for you to sell a portion of your grain through Farmers Keeper. And then finally, to execute your own marketing plan. Everybody's got a different break even, different risk tolerance in the market. And we want to put the tools in your hand with the knowledge that we're going to talk about today on how to execute what your thinking is about the market so that you can go out and do that. You know, when we used to just manage pricing programs for farmers, that was us executing our own market plan with our own marketing plan with our clearing firm partners there. But today we're giving you the ability to do what you're already doing with the vast majority of the rest of your bushels that you already sell so that you can get these other benefits of avoiding paying margin and being able to deliver your bushels wherever you want. So you get the best basis available. And not only getting the best basis available, those of us that live close to the rivers this year, how is that experience trying to deliver on your contracts to the river? Would it have been nice to shift more of your bushels away to a local end user or something like that that you normally may not have usually delivered to? That's also the flexibility there as well, to be able to avoid long lines or anything like that and get paid. Let's start off talking really basic about an HTA, also known as a hedge to arrive. Hedge to arrive is similar to just setting futures on the board. So when you set an HTA, you can decide if you like the current market price. You can sell however many bushels you want at that price and lock it in and then set your basis later. So we know that futures prices and basis are going to be typically different from each other. And the futures prices might be higher than at a certain point in the year than when you want to set basis. So everybody knows, about the first week of June for corn and soybeans, that tends to be, over the long run, the first week of June tends to be the highest futures price for December corn and November soybeans. Let me say that again. Over the long run, the highest price on average for corn and soybeans on their harvest contracts is the first week of June. So that's not when most of you are setting basis, which we track when we're setting basis on the bushels that we manage. Most of us are setting basis a little bit closer to harvest when we've got an idea of what our crop is and where we want to deliver things. So if you do your HTA through Farmer's Keeper, you can take advantage of that futures price wherever you think it's good or not. And then later on, you can set your basis, but you, instead of locking in at the elevator and having to set basis just with them, you have the ability to set your basis at any elevator you want. The vast majority of the farmers that sell grain through us deliver to more than one elevator, and that basis flexibility is important to them. Again, I just want to note about offers. If you have certain price levels in the market, why not just place an offer and let it ride? And you could be sleeping or in Florida or planting or fixing equipment, right? And that level could hit, and you've captured that in case the market, like it's been so volatile these days, hits a certain level that you wanted to sell at. Next, I want to show you a comparison so that you can understand what the price looks like doing it through Farmer's Keeper versus just selling futures on the board. So there's a lot going on here in this slide, but I'm going to break it down for us. And the top row here, I've got about the average price that we've been looking at for December corn, November beans, and July wheat. And if we look right now on the CME at the next row, the cost of one contract of margin, 5,000 bushels, for corn is $1,700, $2,800 for beans, and $3,200 for wheat. So if you were going to margin 100,000 bushels of corn and go out and sell, which some of you just live on this call do as a normal sale for yourselves, you've got to put up today, the day you make that sale in futures on the board, you would have to, for 20 contracts, you would have to put up about $34,000 in order to hedge that grain. You want to do that on your operating loan? Well, if you look at the HTA cost per contract through Farmer's Keeper at the rate that comes off of your settlement check, our harvest rate for an HTA is 9 cents for corn and 13 cents for beans. So when you compare that times 5,000 bushels, that's only $450 that you have to pay, which if we look at the bottom on corn, that's a 73% savings versus doing it on the board. On wheat, it's the biggest. It's actually 81%, almost 82% savings versus selling your grain on the board. Those of us who have the cash flow for that, do you want to do that at 7.5%? Others of us might look at a 9-cent HTA on corn and say, well, I live right outside of St. Louis and I get free HTAs or 2 or 3 cent HTAs. Well, if the difference in basis between the elevators that you deliver to is no more than 5 or 10 cents, it probably doesn't make sense to do your HTA through Farmer's Keeper. You should take that business directly to your grain elevators, because you're going to get pretty much the same elevator in a St. Louis market, for instance. You're going to get pretty much the same basis bid from any of the big ABCDs. So you might as well get their cheap HTA, right? You don't need basis flexibility. But on the other end, extreme example, those of us in the Dakotas or out in the Western Plains, you can see, especially like a lot of us did at Harvest here, you can see a 50 cent to a dollar basis swing between one elevator to the next. And that creates a lot of value for you. So we're not just looking at what's the cost versus doing it on the board where you can just liquidate it and then make a cash sale wherever. We know that's a lot cheaper through Farmers Keeper, but you've got to also look in the cash market and say, is it worth it for me to do an HTA that might be a little more expensive? By the way, not necessarily more expensive for all of us in this group. Those of you in those other states actually pay more for HTAs at the elevator, but you've got to figure, is my difference in basis at my local elevators greater than spending 9 cents on an HTA? Do the math. If you do it on the board, your HTA as a cost per bushel on margin for soybeans is 56 cents. So you margining one contract of soybeans is 56 cents off of that. And there's no guarantee that you're not going to have to make a margin call on that. There's no guarantee that you're going to hit the high of the market. So the point of this is just to demonstrate that there are different reasons for different times to use those three tools available. Either a direct sale at your elevator when you don't have as much of a difference in basis between one elevator to the next. You might as well do a 3 cent or free HTA, which, by the way, nothing is free. When you get a free HTA at the elevator, their cost is also 9 cents. They're just charging you on the basis where you don't see it. They're not eating margin money for you, right? But there's also a scenario to do it on the board. Let's say you're in the Western Plains and you're worried about hail all the time, or it's been really dry the past few years. Maybe it does make sense to make some sales on the board then potentially for you, right? You don't want to commit physical grain. But there's another group of your bushels that you might not know what elevator it's going to go to, and you don't want to have to leverage your balance sheet to put it up on futures and options, where you probably should think about doing a pricing tool through Farmers Keeper. This is a really important slide. Those of you that have your cell phone out, take a picture of that. And we're recording this anyway. I'm going to send everybody, but that quantifies what it looks like selling your grain through Farmers Keeper versus the other options that are out there. Average price contract. All right. So what the average price does, a lot of us have done it before, is it allows you to capture seasonal highs in a time frame that you want. So just like I said earlier, right? If you look at the past 20, 25 years, on average, the highest price for the December corn contract and the November soybean contract has roughly been the first week of June, about 6 months ahead of harvest. So many of our customers and many of you directly at the elevators look to do an average price contract, for instance, let's say from May 15th to June 15th. And what you can do is, if that's a 5-week time period, let's say, that you choose to set your average price contract on, and you want it to price weekly at the close on a Wednesday, and you commit 50,000 bushels of corn to that structure, you will price 10,000 bushels of corn every single week for 5 weeks to get sold of 50,000 bushels of corn. And at the end of that, you're going to get the average price on the closes of Wednesdays of that time frame. So for the price roughly of an HTA, you can capture when you think there are going to be seasonal highs, and then still, again, have your future set without worrying about margin calls, and then deliver those bushels to whatever elevator you want, or roll them out later and store them if there's a carry in the market, and then make that decision again later. So the average price is a pretty straightforward one. And it's got a lot of use if you like a certain seasonality. Now let's talk about a price floor. Many of us here at Farmers Keeper hear from our customers every single day, especially where the market's at today. Man, I really like where prices are at, but I'm kind of afraid that things are going to rally again like they have been over the past couple of years, and I'm going to miss out on that rally if I just set a price at the market on an HTA today. So what a floor does for you is it allows you to get a minimum price that you will not sell your grain below on futures, no matter what. But it also allows you to participate in if the market goes up. So when you already see strong prices that you like many of us see right now, especially as insurance premiums are getting set or insurance guarantees are getting set for the spring price, many of us are looking at that and saying, man, I'm still kind of profitable, maybe not as profitable as 2022 because inputs have gone up and interest has gone up, but I might want to put 40 cents of protection, let's say, to set a floor. So here's an example. If you have a commodity that's worth $10 and you set a floor worth 50 cents on it, you will effectively have a minimum price of $9.50. $10 minus the 50 cents of premium that you paid. You will not sell grain below $9.50. So if the futures price of that commodity goes from $10 all the way down to $9, you will have your floor at $9.50. If it goes to $2, you've already set your floor at $9.50. But what the really big benefit is if that commodity goes from $10 up to $20 because there's an enormous rally because of big global concerns and a drought and all this type of stuff, you're always going to stay 50 cents below the market, which is the premium that you're giving out for having that floor. So if the market runs from $10 to $20 at expiration, you're going to get $19.50, 50 cents below where the market ended up. And that's a pretty good deal to ensure yourself a floor. You can talk to your farmer relations rep at Farmer's Keeper or your merchandiser at the local elevator about what those premium levels look like to see if it's worth it for you, because obviously that changes with the market. Any questions about floors? We get this question a lot. So if you think of anything, put it in the chat in the bottom right-hand corner. You'll see like a little chat pop up, or just text your Farmer's Keeper representative too, or unmute yourself and you can talk. Now, everybody wants to set a floor on their grain and be able to participate if there's a rally. It's great protection, right? But sometimes there's some sticker shock when you hear how much it can cost at certain times to put a floor under your grain. And that's why we like to do for people what's called a collar. Many of us know it at the elevator by the name of a min-max. The reason it's called a min-max or a collar is because it is giving you a range of where your price can be set. And basically what you're doing is, if you think a floor outright costs too much, you can finance having a floor by selling premium at a call and capping out your top price a lot cheaper. And typically when Farmer's Keeper does it, we do it quote unquote costless to you, the farmer. So in other words, when we sell that call premium for your capped out top end price, that covers the cost of the floor that you're setting that you will not sell below. So if options are just too expensive to set a floor outright, that's when you might look at doing a min-max, aka a collar. We also like it for some of those bushels that you know you're not going to price until delivery period, that you just want to keep protected. So what you're giving up for a costless floor is you are capping yourself out at a max price that you will sell at. So again, if we have a commodity that's worth $10, you might get a collar or min-max quote that gives you a floor price of $9, which you will not sell below, but it also gives you a cap price to finance that of $11 that you will not sell above. So in those scenarios, if the market expires at $10, you'll get $10 basically as a free HTA. You won't have any type of fee associated with it. If you land between $9 and $11, you're going to have that futures price guaranteed. If the market falls though below $9 to $8, you will have a floor set at $9. If the market falls to $5, you will still have a floor at $9. And you finance that protection by giving yourself a cap out level, in this instance, at $11. So if the market goes to $11.20, you will have capped out those particular bushels you committed at $11. If the market rallies to $12, the max futures price you will get is $11. So that's what you're giving up in order to finance yourself a cheaper floor. Again, just like looking at the floor quotes, these are things we're quoting for our customers every single day, and your elevator can quote for you as well. These levels change based on how wide you want them or not. So talk to your farmer's keeper rep or your merchandiser at the elevator to figure out what's a level that makes sense. So for instance, if you want to raise your floor level, it's probably going to shrink down your cap top level, right? The high end of what you can sell. And any good merchandiser or anyone at Farmer's Keeper can help talk you through those scenarios. But again, this is a great way to finance a floor on your grain where you're not really sure you want to price those bushels yet, but you want to set a floor and not have to pay for an expensive floor on it. All right, accumulators. This one is the hot topic out there that people have heard about, people are afraid about, people have heard horror stories about, but there's not really a lot of understanding about accumulators. You know, an interesting note about accumulators, when we look at our portfolio of customers at Farmers Keeper, just over 1,000 farmers, and we've paid out over $100 million worth of grain checks to farmers that have sold grain through us in managed pricing programs and pricing tools. We see that an outsized number of those producers that work with us that produce more than 1 million bushels of grain use accumulators. And we think a lot of times it's because they tend to be a little bit more knowledgeable about the mechanics of futures and options. But a lot of us have heard, especially since the market took off about 3 years ago, we've heard horror stories about accumulators that some neighbor got doubled up and they had to commit way more grain than they had and all this type of stuff. So accumulators are a very powerful tool, but you've got to know how to use them right. Let's talk about it. So an accumulator is a great tool to use in a range-bound market where things are pretty much going sideways. And what it does is it allows you to capture premiums above the current market. What does that look like? There's two words that you need to understand. One is the double up, and the other is the knockout. So if we look at the graph that we've got here, and futures prices are set at $10, let's say that you've got an accumulation level or a double up where you can sell above the market at $11. Man, I'd love to sell $11 futures in a $10 market. Well, we've got that high end of $11. And unlike the rest of the pricing tools that we've talked about, where you don't necessarily know what price you're going to get other than the HTA, but you do know how many bushels you're going to sell, the accumulator is flipped. You know that every bushel that's sold in an accumulator, in this example, is going to get set at that accumulation level of $11. What you don't know is exactly how many bushels are going to get sold, but you do know within reason. So if you had bushels and you said, you know what, I've got 100,000 bushels in an accumulator, scary amount for some of us, but I just want to use round numbers. You know that if you commit 100,000 bushels, you will sell somewhere between 0 and 200,000 bushels of grain. And all the bushels from 0 to 200,000 that get sold in that structure will be sold at the price of $11 futures. Let's talk about what those scenarios are. So if we start a 100-week-long weekly accumulator with 100,000 bushels, that means that every single week at the close of a Friday, you will price 1,000 bushels, 100,000 over 100 weeks at that $11 price range. So for every week that the market closes between your bottom knockout level, in this case, $9, and your accumulation level, $11, you will sell that 1,000 bushels at $11. So if the market closes at $10 futures, you will sell 1,000 bushels at $11. If the market closes at $10.95, you will sell 1,000 bushels at $11. If the market closes at $9.01 above your knockout, you will sell 1,000 bushels at $11. No matter what, the bushels that you sell will be at a $11 strike price. Let's say we get to week 50 and the price of the futures has always stayed between $9 and $11. In week 50, you will have priced 50,000 bushels at $11. And on week 51, maybe the market rallies up and it closes a Friday at above your double up level, which is $11, at $11.10. For that week, instead of selling one time the bushels, which is 1,000 bushels, you will sell 2,000 bushels in that example. So because it closed that volume above $11, you're going to sell 2,000 bushels still at $11 futures. If the following week we go back down below $11 and we settle at $10.75 and we close that week at $10.75, you will go back selling 1,000 bushels at $11. Any questions on that? Let's say then at that point, you've sold 52, 53,000 bushels, right? Here's where the knockout comes into play. And we can do these with a floor too, but I just want to, for the purpose of this conversation, I just want to talk about a basic accumulator that you're going to get at your local elevator that many of our customers do. What the knockout level means is if at any point in that 100 weeks, the futures price of the contract drops below $9, which was our knockout in this case, you will stop pricing grain. So if in week 50, you've only priced 50,000 bushels of grain, you never doubled up, you've been playing that range bound market really well, selling above the market at $11. If at any point the contract trades below $9, the knockout, the structure ends and you will stop pricing grain. So if you committed 100,000 bushels and you got knocked out on week 50, you are sold at 50 weeks worth of grain and it's over. You're not going to price any more bushels. And different than some elevators, if you do get knocked out on half of your bushels, you're not committed to sell the rest of those bushels through Farmer's Keeper. So if you got knocked out and you've only priced 50,000 out of 100,000 bushels, the rest of those 50,000 bushels, you can price and sell however you want. So that's the scenario of why you can sell between 0 and double the quantity of bushels that you have. Because it is possible that you could execute an accumulator today and sell, and the market drops on the next day and falls at the knockout level and you get knocked out and you price 0 bushels. Or you could set an accumulator up and the market screams higher through the roof and we never fall below your double up level and you could end up selling double the amount of bushels that you committed. That's how that works in general. And again, those of you on this call or watching in the recording later, however far down the line, this stuff is pretty much universal wherever you're going to set this, whether it's through Farmer's Keeper or through your elevator, but make sure that you're checking because some accumulators have a double up where if you double up one time, you double up the whole volume of your bushels. We don't structure them that way because we don't think that's safe enough for farmers. So that's how accumulators work. Let's talk about, if you wanted to execute one, some best practices for them. So here's what we usually say. Farmer might come to us and say, all right, I want to sell some grain and I've got a price target above the market. Let's say the market's at $10 and I've got a price target of $11. Maybe we can see that an accumulator can get you to that price target already today. So what we like to say is, since we know that you might double up on bushels, this is how we keep you safe when you're doing an accumulator so that you don't have the issue that you've heard about the neighbors got doubled up and they overcommitted their volume. We always ask and say, hey, you can get an accumulator that will net you futures today, let's say $1 above the market in this example. So if the market was at $11 today instead of $10, how many bushels would you sell on an HTA? And you might say, keeping consistent here for easy numbers, you might say, man, Nick, if the market was at $11 today, I would do an HTA for 100,000 bushels. What we typically say at Farmer's Keeper is, then what you should do, instead of committing an accumulator for 100,000 bushels, do about 50 to 75% of that volume. So do 50 to 75,000 bushels instead. The reason we say that is we want you to be safe and we don't want you to be overcommitted. Okay. Look, we make money on how many bushels you sell through us. But what we don't want is you to unsustainably be doing something that's going to put you in a bad spot, because then we're never going to sell bushels for you, right? So we always say take that down by 50 to 75%. Because if the market does rally and you end up selling a lot of double up bushels and you get sold, up to that 100,000 bushel range, at least then you're at a level that you were comfortable already with setting at that price. And if the market goes from $10 to $11 and you just got doubled up on all your bushels, you ended up doing 50,000 bushels in the accumulator, you doubled up every week, and you had to sell 100,000 bushels at that price. Well, you're right where you started. You're right where you wanted to make those sales anyway. And now you're not over committed if the market screams higher for you to sell more bushels anyway. And of course, if you do thread the needle and you play that range bound market, all the better for you. You just have to be conscious of that knockout level too, in case things fall down where you're going to stop selling grain. Something that's been really popular lately that a lot of our customers have started doing has been accumulators with a floor underneath them. That way, that if the price falls down to that floor, you're not going to sell your grain below that and you won't get knocked out. So you'll at least get priced on those bushels. It's all about, in an accumulator, managing your expectations of how many bushels you're going to sell, because otherwise it looks really attractive to get that accumulation level. You just want to do it with the right amount of bushels, the right volume. Any questions about any of these structures? I know it's early in the morning when we're recording this, but if you have any questions, either you can unmute yourself or you can put something in the chat. And again, all of this, as anyone's thinking out there, all of this is in an effort for us to try to get more farmers better educated on how and when to use these tools, because we talk to a lot of different farmers out there of all different sizes all throughout the country. And we do get a lot of these questions, because what we find a lot of time is maybe that's you sitting there. Sometimes people are afraid or embarrassed to ask the question about what's going on. Somebody actually just texted me a question that I'll answer in a little bit. But we want to just, in a non-pressure way, give out this information to you to know, again, that you can execute, for the most part, any of this stuff at your local elevator too. I'm going to go with Brian's question in the chat here. He's asking, which one of these pricing tools do I like best? A lot of our customers think that way of what's the best pricing tool out there. Those aren't any good, one or the other, right? John is saying he likes HTA. I'm guessing A means HTAs. My answer to that is it depends on your own risk tolerance, where you're sold at, what your break evens are, what your current average price is, and what you think is going on in the market. The whole point is when to use each of these different tools. Think about it when you're working out in the shop. There are some times that you use a metal hammer. There are other times you use a rubber mallet. And there's other times you might use a wooden mallet, right? It's a similar type of tool, but that you use for different situations. And so that's why we see ourselves not as an advisory firm that's giving you advice on where the market's going, but we're really here to help you figure out, based on what you're thinking, maybe some of our opinion too, if that's what you want, to help you determine how to execute your strategy the most cost effectively to get you a profitable price. I get a lot of complaints about this from keyboard jockeys on TikTok and all this type of stuff, saying, you guys in the industry, you're always trying to tell farmers just to sell early. Well, you know why we do that? Because we want you to have a successful price in your business. We want you to be profitable. We want you to take things while they're good, because there's no telling what's going on in the future. So let's have a constructive conversation together about what is the best pricing tool for you in that situation. And that's a conversation we can have all day long, because what we can't do is guess where the market's going to go. Sorry, nobody can. Josh is asking, what are realistic prices that you could use today for November soybean accumulators? Jack, Luke, Jeremy, what as of yesterday? So I'm locked in on this webinar, but we're going to give you let's run our quotes from yesterday. Check out what they were yesterday and take a look. If we're looking at November soybean accumulators, so Jeremy just chatted here what they were from. Is that from yesterday, Jeremy, or today? So this is fresh as of this morning. So the board this morning on February 16th or 17th, 2023 is, you guys are texting me too, nice. The board price is at, man, this is really good for you guys to read if you're looking in the chat here. So the board price is 1373 and a half right when this was run. There's a knockout level that you will stop selling bushels at $12.93. And you can net futures of $14.15. Every bushel you sell will be $14.50 today. And you won't double up your bushels. Actually, you got another 20 cents worth of cushion that you won't double up unless the market goes above 14.37. That's an indication right at the market at the open today. But that's the standard way that Jeremy just sent here. Man, I really want to get this up into the presentation for everybody. That's a standard way that we run quotes for you. And I'm going to get this into the presentation above by sharing my screen up there. I'm going to pop up my entire screen up there. And I'm just going to send you right here. I'm just going to show us exactly what Jeremy just sent, right? So for everybody watching at home that wasn't looking at the chat, today the board price happens to be $13.73 when this quote was ran. You can net futures on any bushel you sold at $14.15. You won't double up your bushels until $14.37, and you've got a knockout at $12.93 or yeah, $12.93. So let me draw this out for you guys real quick. Check this out. Okay, I'm going to come really close for us. This is the way we look at it at Farmers Keeper. All right. So let's say the first question I'm going to ask you is at $14.15. If the board was at that price today, how many bushels of beans would you sell? Josh, you want to tell us how many bushels you would sell? Think about it while I'm drawing this. Maybe it's 0, I don't know. But let's say that number was something like 10,000 bushels of beans. We would say, hey, you might want to think about doing 5,000 or 7,500 bushels of beans, right? So we've got the board price today is at $13.73. And your knockout is going to be at $12.93. You've got your accumulation level that you will sell all your bushels at is at $14.15. And then you actually won't double up the way we quote them until $14.37. So to run through those scenarios, here's what you got to know, right? Can we all see this? Cool. So we're at this board price today. Man, I'm going to be able to sell 42 cents above the market. That's great. So every bushel that I sell is going to be at $14.15. As long as the market stays in between this level between expiration, I'm going to sell 1x my bushels at $14.15. Man, that's a great sale above the market. But if we end a week above $14.37, let's say we end one week at $14.40, instead of selling your weekly volume of 1,000 bushels a week, you're going to sell 2,000 bushels that week. And if we end a week down below the knockout level on week 50, let's say, and you've only priced 50,000 bushels, you will stop selling bushels. You've sold 50,000 bushels at $14.15, and you are done. The rest of those bushels that you had committed here, you can go sell through Farmers Keeper or anybody else. We're not locking them into you. Make sense, Josh? I want to see if there's any questions about that.
Yeah, it makes sense.
Cool. Josh, when's the golf tournament this year? We want to sponsor again. And I'm playing this year.
First Friday of August.
Sounds good. I'm not running a booth, I'm playing. Okay. Marshall. Marshall's asking, is the price above and below the market at the time of setting a collar always equal distance from the market price of the day? Very good question, Marshall. It's a common question that we get. Let's draw this out, okay? So Marshall's asking if the market is, if I'm going to set a collar And in this example, the market is at, let's say $10 again for the easy numbers, right? So check this out, right? I'm going to get rid of this accumulator example from your screen up here too. So collar, all right? Let's say the market right now is at $10. What Marshall is asking is, will my floor and my cap be equidistant from $10? And the answer is usually not. It depends on where option premiums are in the market. So in Marshall, in your example, what you're, I'm assuming, saying would be, is it going to be something like this? A $9 floor and being equal to each other, this would be a $10 floor. That's not necessarily, excuse me, an $11 floor. That's not necessarily the case every single day. Jeremy, do you have the collar quotes run yet today? Can you chat them in here? And I'm going to put them up in the screen. Let's take a look, Marshall, on, we'll stay with November soybeans. Let's just take a look at what those different levels look like right now. Jeremy's going to chat them, and I'm going to take a screenshot and put them up in the recording here, because it's just going to vary based on options and premium levels. So right now in the chat, those of you looking, there's 3 different levels of collars that we're looking at. And I'm going to try and share my screen up here again. All right. Share. All right, cool. So there we go. So there's 3 levels of collars. The board today is at 1374 when this quote was run. And in the top example, you can see you can cap yourself out at 1440. That's pretty high, but you're going to have a lower floor compared to the other ones at 1260. That's roughly 70 cents to the upside, 66 cents to the upside, but it's like $1.10 to the downside in between those levels. Next, same board price, but different risk tolerance built into it. You've got about 46 cents to the upside, but you got a higher floor comparatively by 20 cents. And then finally, in a more aggressive model, you've got a higher floor of $13, but that reduces your cap now to $14. And in this case, you're 26 cents away from your cap and you're 74 cents away from your floor. So it's just going to vary day by day based on your risk tolerance. And again, we run these scenarios for you guys as standard. These can be customized if you say, you know what, I want to bump that floor up a little bit more. We are just always going to give you the safest scenario possible where it's costless to you. In other words, your cap level is enough to finance what the floor is. Most of our customers want stuff that way. If you want to customize this stuff, you can do it that way. It's not a problem. These are the questions we're getting here about accumulators and collars. I would say those are the most common questions that we get about those structures. I wonder if there's any other questions. To those of you who are going to watch this as a, as a recording later on, you can reach out to us and email us with any questions. To those of you who are on this call now and may have some other questions, many of you on the call are customers already. Feel free to reach out to us and we'll explain more of this. But again, the purpose of today is to give you more information about how all these pricing tools work, when to use them, and know that you can execute all of those, either through us or through your local elevator. Okay. So Josh is asking a question about the fees on accumulators. That's not something set like on HTAs. We basically give you what your net futures is, Josh, and any of the premiums taken out are all baked into that. So if we quote you today, like Jeremy did, right, you're going to net futures of $14.15. That's what your net futures is going to be with everything taken out. So no surprises there. Versus if you did an HTA at 9 cents, let's say you sold $7 futures because the market hit that, and you got $7 on a 9 cent HTA, you would net futures 691 plus or minus your basis. And that's how that all works. Again, any questions you have, feel free to email us, call us, rewatch this when we do the recording. We're going to send this out to everybody. But more farmers should know how to use all that type of stuff. Brian, delivery on the accumulator on this or any structure you do is typically going to be in that futures month, or excuse me, in that futures period that you set. So if you do something on December corn, your delivery, unless you roll, is going to be from October, November, December. Otherwise, you can roll forward if you want. You can roll backwards. You're not fixed just because you're in a December program. You don't have to set basis and deliver in December. That's totally up to you. Some of you on the call that I'm looking at here love to play the basis and roll things out and store your bushels. And other people sell a lot more at harvest. It's totally up to your situation. But anyway, we want to give you some of your time back this morning. Thank you, everybody, for joining here. Make sure you reach out with your future questions and talk to us about what that all looks like, because there is no one best pricing tool out there. It's about you, your risk tolerance, where your finances are at the time, and then what you think is going to happen in the market. Because otherwise, if we're just playing the market guessing game, that's going to be a losing game in the long run. Let's all make good, profitable decisions so you guys can sleep better at night. Thanks, everybody. Take care. We'll talk to you soon. Have a great day.
Grain pricing tools, no margin, play the basis. Farmer's Keeper. Click the link below to supercharge your grain marketing.